Penguin Random House Audio presents The Problem of 12, When a Few Financial Institutions Control Everything, by John Coates. Read for you by Sean Patrick Hopkins. Note to listeners, this program includes a downloadable PDF that contains charts and illustrations from the book. Introduction. A problem of 12 arises when a small number of actors acquires the means to exert outsized influence over the politics and economy of a nation. 12 is a notional number. The precise number is simply a small one. In U.S. history, problems of 12 have recurred as the result of a clash of two fundamental forces: economies of scale in finance on the one hand, and constitutional commitments to fragmented and limited political power on the other. Each time, the problem has been two-sided. The concentration of wealth and power in a small number of hands threatens the political system and the people generally, and the political response can threaten the financial institutions in which wealth and power are accumulating, even when those institutions create economic benefits. Today, two late 20th century institutions, index funds and private equity funds, are creating a new problem of 12. As financial organizations, they amass and invest capital and have been primarily scrutinized through a financial lens. As with other financial institutions, they pool savings from dispersed individuals and channel it to fund major projects. They facilitate capitalism, which has created huge benefits for humanity, wealth, health, and much longer lifespans, along with inequality, misery, and the existential threat of climate change. Finance creates value by facilitating change, but distributes the gains unequally and magnifies the gales of creative destruction. But both kinds of funds are now so large and have influence over so much of the economy that they have economic and political power, whether they want it or not. Their power makes them targets of political threats. Both institutions exhibit economies of scale. Both are active politically, directly and indirectly, through their control of businesses. Their growing and concentrated wealth and power threatens the foundations of a democratic republic built on Montesquieu's separation of powers, as well as federalism, the checks and balances taught to every civics student. In a predictable response, the Republic is increasingly threatening each type of institution with new restrictions, burdens, and limits. Because index funds certainly, and private equity funds possibly, create value within the U.S. economy, the threats to them are as important as their potential threats to American democracy. The book proceeds as follows. Chapter 1 notes prior problems of 12. Those created by central banks, private banks, insurance companies, and money trusts. It summarizes how policy responses to those problems left the dominant form of U.S. business, large companies owned by dispersed investors, in control of their executives, with weak public legitimacy and accountability, as diagnosed in 1932 by Adolph Burley and Gardner Means. Chapter 1 also reviews ways that the law and policy restored the legitimacy of those companies, and hence of capitalism, from the depths of the Great Depression, directly with securities law and disclosure requirements, and indirectly with labor law, taxation, and regulation. Chapter 2 reviews the emergence of index funds in the last decades of the 20th century, and analyzes their growing scale and influence. Core parts of the story include a revolution in financial theory, the slow diffusion of a powerful investing idea, and the ways that index funds have managed to exert increasing influence on large businesses despite being heavily regulated in ways that include extensive disclosure requirements and prohibitions on exerting direct control over companies. Chapter 3 describes the transformation of the limited and controversial buyout firms of the 1970s and 1980s into the massive and ever-expanding private equity industry of today. Core parts of the private equity story also start with finance theory and innovation. But unlike index funds, private equity firms have engaged in persistent and largely successful political and public relations efforts to keep the public in the dark about how they operate and restructure companies they control. I also explain the ways that private equity has, over time, become more complex and permanent as a form of ownership and control over businesses. The chapter ends with a review of the limited research on whether private equity provides net economic benefits to investors and of its potential for inflicting harm on others. Chapter 4 lays out the political side of the problem of 12 that each of these types of funds creates. The largely successful efforts by business lobbies to shed the limits of labor law, taxation, and regulation during the last 20 years of the 20th century were coupled with new economic challenges, including globalization, technology, and inflation. The results, hostile takeovers, buyouts, and the emergence of a powerful new institutional shareholder movement, all accompanied by falling public trust in business, are important parts of the current political landscape, in which index funds and private equity funds are feared and threatened. I then review the political activities and influence of index and private equity funds. Index funds already face limits on their power, are more likely to vote in line with retail investors than with other institutions, and are more varied in their political positions than is typically appreciated. Private equity funds, by contrast, are drawing a veil over more sectors of the economy, leveraging politically controversial tax breaks, continuing the suppression of labor and increasing wealth disparities, and being excellent at whatever private, for-profit business they do, whether increasing productivity or imposing social costs. The chapter includes specific examples of the kinds of political threats each type of fund poses and faces. The book ends in Chapter 5 by asking, what can be done? What kinds of policy responses might contain these new problems of 12? Can we reduce the political and policy risks that each institution creates without reducing the economic benefits they create? My analysis and answers are tentative. The choices involved are matters of judgment. Yet it is clear that some blunt responses, particularly those involving index funds, will require a higher price in the form of economic losses than further blunting the political influence of index funds justifies. Others, those involving more disclosure requirements and some form of public consultation, seem likely to be beneficial. In between are other ideas worth exploring. More vigorous application of antitrust law to the companies each type of fund owns, more robust application of conflict of interest rules, not just to the funds, but also to their advisors and affiliates, and articulation and enforcement of fiduciary obligations, not simply to investors, but to the broader public these funds affect. What came before? The 20th century's public company. The current problem of 12 is new, but it echoes, in a more extreme form, problems that have arisen before. To appreciate what the problem is, why it has arisen, and how we might cope with it, we need a picture of what came before. This chapter reviews how the U.S. economy came to be dominated in the 20th century by what is called the public company. Public companies are large businesses with shares traded on a stock exchange. Examples are household names: Apple, AT&T, Costco, Exxon, IBM. Roughly 70 to 80% of all corporate ownership has for over 100 years consisted of public companies' shares. There is a deep structural conflict between American-style democratic republicanism on the one hand and capitalist economics, particularly in finance, on the other. Democracy, as practiced in the U.S., has from the founding been suspicious of and has imposed legal and political control over any kind of concentrated power. Capitalist markets often generate economies of scale in finance, which tends to concentrate wealth and power. The result is a repeated pattern of evolution toward concentration, followed by political reaction and the embrace of laws and institutions that effectively sacrifice some economic value to thwart the risk of tyranny. Public companies in the early 20th century had many qualities, both good and bad, that today also characterize the funds that create the problem of 12: size, growth, concentration, economic dominance, political influence.
Sample complete. Ready to continue?